gentlemen.
Great. Thank you for having us. Thank you all for coming and hosting us. We really appreciate being here. It's always fun. And I have two phenomenal real estate minds here, so hopefully we'll get a good discussion going. Just by way of introduction, I'm David Becker. I head up the equity department at Time Equities. On the investment committee, we have properties all over the U.S., Canada, Western Europe, and the Caribbean. And give it to Francis here to say hello and his intro, and then to Bob.
Okay, well, I'm not sure you didn't do the intro, but so I'm Francis Greenburger. I'm CEO of Time Equities. We're a national and international real estate investment company. We have all types of real estate, and as David said, we're in 35 or 36 U.S. States, and in, I think, 7 countries, give or take. We just sold one in Scotland, so maybe we're down to 6. But anyway, but we're started in New York, and we own a variety of portfolio of property in New York City as well. So we're familiar with both the local real estate economy as well as the national and, to some extent, the international.
Great. I'm Bob Knakal. I sell buildings in New York. Been a broker here for 40 years, and thrilled to be with David and Francis. Francis is somebody I've looked up to and admired and respected my whole life, so I'm kind of thrilled to be sitting next to him today. For 26 years...
The admiration is mutual.
Oh, thank you. Thank you. For 26 years, as you can see on the back of my baseball card, I had my own firm, which we sold to Cushman & Wakefield in 2014. And after kicking around at the big global shops for almost 10 years, about 8 months ago, I started my own firm again. So back to my entrepreneurial roots, which I said to folks is like cleaning Vaseline off binoculars. And all of a sudden, everything became crystal clear again, and good to be back in the trenches. So I'm very excited and invigorated again after 40 years. So. But love the business, and really happy to be here today and see so many familiar faces and friends, and looking forward to this chat.
All right, so one way to start off, I was thinking about how to get the conversation started, and I was thinking we'd start with something, given how volatile everything has been over the last few years. I thought I'd start, and I guess, Bob, let's start with you. What keeps you up at night? What are some of the things that worry you?
Well, lots of things, but relative to real estate, not too much keeps me up. From a broker's perspective, we care about transaction volume more than anything. We need activity, and probably the metric that most highly correlated to activity in the investment sales market are capital gains rates. And if you look over the past 40 years, 5 of the top 6 years in terms of the volume of sales have been precipitated by capital gains rate changes. Either people, when capital gains rates are increased, generally they're increased at the beginning of the following year. And so that generally forces people to want to transact and beat the increase in the following year. And when they are decreased, they're rolled back retroactively to the beginning of the year. So people rush to take advantage of that. So, capital gains rates increasing are a great thing for a very short period of time, and then a terrible thing for 3 or 4 years after that. So that's something that keeps me up at night if it were to happen. But generally, I think I try to maintain a pretty even keel with regard to how the market's functioning. And I think one of the things that I take heart in is recognizing that the market always has been, is, and always will be cyclical. We've been kind of in a funk since October of 2015. The bull market, that was actually the cyclical peak. It's hard to believe it was 10 years ago, but in terms of number of buildings sold, there were more buildings sold in 2014 than ever before in the history of New York. 5,534 buildings were sold. That was an all-time record by more than 10%. That still stands. In 2015, we had 80.1 billion in sales volume, also an all-time record. October of 15, the music stopped. From October of 15 through February of 2020, the dollar volume of sales dropped 56%. The number of properties sold dropped 54%. Value is down about 10%. We had a little hiatus from this lackluster market in the second half of 21, first half of 22. Then interest rates started to rise. That's something that keeps me up at night too, David. But interest rates started to rise, causing another downdraft on value. And now we're in a very unique market where different property types are moving in different directions at the same time, which is very different from the past 4 corrections we've had. But basically, not a lot keeps me up at night, but interest rates and capital gains rates are things that we're very, very mindful of.
Before I get to Francis, one memory I had, a very fond memory of Bob. Remember a long time ago you sold, I met you and you sold Perry Street for my family. And I remember my brother and I met with Bob, and he gave us some confidence on a number that, was at the time very ambitious. And we looked at each other, and Bob, his confidence, charm, his ability, his execution ability, and then of course he executed exactly as he said. And I always remember that because we always go back, and there was a very moment where we sort of just had faith in you. So I always appreciated that. It was a good moment.
Well, David, even a broken clock is right twice a day, so I got lucky that time, I guess.
So, Francis, I hear from you a lot because I'm with you a lot. I know some of the things that keep you up at night, but why don't you share some of your anxieties that are out there right now?
Well, unlike Bob, who very insightfully said that as long as things transact, his fate is less tied to whether the buyer or seller made a good decision or a bad decision. But since I'm on the buyer-sell side of every transaction we do, whether the sale is accretive or the opposite is critical. And interest rates are not a guide of the volume of my business. They're what I pay every single month, and we'll probably pay several tens of millions of dollars in interest every month. So it's hardly theoretical, and it's absolutely critical. And of course, all real estate valuations are calibrated to returns. And so the fate of interest rates determine a lot of things. And they determine, to some degree, values, although that correlation is not as obvious as one would think. I can comment on that in a minute. But it does correlate exactly to after debt service cash flow, which is what drives the real estate business. We've all been holding our breath for the last, I don't remember when rates went up anymore, 3 years ago, or
March of 22 was when the Fed started.
Pretty much 2 years and 9 months, and we've all been waiting patiently for the moment that they will descend. And the good news was in late September, early October, they did descend. And of course, real estate rates, we're more concerned with long-term rates than short-term rates, but both because, and the market was ahead of the Fed anyway, even before they dropped the short-term rate, the long-term rate came off. And then, and we actually transacted one deal in, mid-October or something like that, where we got a rate it was a multifamily building in the Midwest at 5.13, which at the time we thought, oh my gosh, the world's coming back. Well, if we transacted that same deal today, it would probably be close to 6. So we have seen since just prior to and since the election that the bond market, unlike the stock's done wonderfully, but the bond market is very concerned with the world that they see ahead. And so the forward curve on SOFR or on treasuries is not showing is showing a very flat pattern for the next 5 and 10 years. So that concerns me. And I think about it because before that I was saying, well, when is it going to break? Well, maybe never, or never, not in the foreseeable future, or until we see some very strong indicators going the other way.
But Francis, do you think we were lulled into this artificially low interest rate environment by the Fed keeping rates too low for too long? I mean, over the last 50 years, the average 10 years, 5.4%.
Well, I'm with you 1,000%. And as you may or may not know, I always based my acquisition criteria based on rates of 5 to 6, even when I think the lowest rate we got was 2.4. I ignored that and was always buying around 5 to 6. But now, guess what? I wake up in the current world is somewhere between 6 and 7.5, and if you have floating rate debt, it's 7s and up. So we've even surpassed where now we've gone from being sub the average rate, 2% or whatever you want to say, and of course we talk about 2%, but 2% is 40% of 5.5. So these are really macro, very large movements. And we're now in the mid 6s, let's say, which is 20% above the long-term rate. So we're recovering from the cold shower that brought us out of the fantasy of sustained short-term rates, even though they were around for a while. But now we're in an even worse nightmare than we could have reasonably expected. I promised that I'd comment, and then I'll let it go there. One of the interesting things is that you would theoretically cap rates, the rate at which properties are sold, should move in tandem with interest rates. Peculiarly, they don't. And I remember a debate between Sam Zell years ago and Steve, the chairman of Vornado, Steve Ross.
Yep.
Ross. And Zell, in his typical style, said to Steve, show me where it is written that cap rates move in tandem with interest rates. And he was 1,000% right, and this was probably 10 or 15 or 20 years ago, I don't remember. And it's been right this time. Cap rates maybe have moved up, whereas interest rates have clearly moved 200 or 300 basis points. Maybe cap rates, not necessarily New York, maybe a little bit more in New York, but nationally, maybe 50 basis points. So very little movement in cap rates in comparison to interest rates. And we're even in an environment where I can make a strong argument at today's interest rates for buying real estate, not on a leverage basis, but on an all-cash basis, because the rates of return for the equity portion are mirroring interest rates.
Yeah, Francis, we always say that cap rates are more highly correlated to capital flows than to interest rates.
And you're probably right.
So, given that, let's drill down on a market, and I know we're here in New York City, and we were just chatting, the three of us, if you gauged New York City by the traffic getting up on our car rides here, the place is bustling. So, Bob, are you a bull or a bear in New York City?
Look, I think up until about 9 months ago, I had always said the best buying opportunity I'd ever seen was during the savings and loan crisis in the early 90s. It's seemed like everything was really, really cheap. Nobody had money, and if they had it, they didn't want to spend it. I think that today we're seeing the best buying opportunity ever, even better than the S&L crisis, if you believe in New York, if you believe in the future of New York, and that's a big if. I will say that, I love the city. I think it's the greatest place in the world. I was not tempted to go out of the city during the pandemic. A lot of my colleague friends in the brokerage business went to Florida and Texas and Tennessee and all over to do deals. I wasn't tempted to do that. I love this city, and if you believe in the city long term, I think you should be buying property here today. Show me a market where price per square foot drops to a point where it's where it was 20 or 25 years ago. How could you not be buying today if you believe in the future of New York City? And it requires courage. You have to have guts to do it. But I always say, all you need to buy property is capital and courage. And for those that have courage, I believe that 5 years from now, investors in New York are going to look back and say, what the heck was I doing? I should have bought everything in sight in 2024 and 2025. And I believe the city will come back. I think we have a very unusual circumstance where our real estate market, particularly in multifamily, is more highly tied. Its performance is more highly tied to public policy than to supply and demand, which is really remarkable, but it's a fact. And I think that the biggest problem we have in the city is voter apathy. Only 14% of our registered voters actually vote, which is why we have so many people who are making policy that don't know what the heck they're doing. So I think to the extent that people became more politically aware and tried to educate the folks who are making policy, it would be better for the city. But the political pendulum will swing. It's heavier than I've ever seen it, so it's going to take a Herculean effort to swing that pendulum. But I think it will, and so I'm a bull. I'm a bull on.
And
on
Bob,
New York.
in staying with that, and I'll move to Francis in a minute, or an operational side. But velocity and investment sales activity. Are you seeing it come in now? Are you expecting it? How are you sort of gauging the?
Yeah, I think next year is going to be a rocket ship ride. I was on CNBC with my buddy Brian Sullivan in February. And I said, Brian, next year in New York, you're going to see more turnover than we've ever seen in history. And a lot of people called me and emailed me after this, Bob, what the heck are you talking about? There's no way that's going to happen. And if you looked at first quarter of 2024 numbers, it was completely flat with performance last year. If you look at the numbers after the first half of the year, we were on pace to be up 40%. At the end of the third quarter, we're on pace to be up about 60%. By the end of the year, I think we'll be up 80 or 90%. And if you use Manhattan as a microcosm of the whole city, south of 96th Street, there's 27,649 investment properties. Of that stock of properties, the average turnover rate over 40 years has been 2.6%. And remarkably, it was 2.6% at the end of the 80s. 2.6 at the end of the 90s, at the end of the noughts, at the end of last decade. It's been pretty steady. The lowest the turnover rate has ever been is 1.2% in 2009. The highest it ever was 4.3% in 2012, as people were rushing to beat the 3.8% capital gains tax increase that was embedded in the healthcare law. But I think what we're going to see in 2025 is a turnover rate that's going to be between 5 and 6%. Higher than we've ever seen. Why? Because, as I alluded to earlier, this correction is very different from the past four, in that during the past four, every property type was losing value. It just was a matter of different degrees. Today, different product sectors are moving in different directions. I would argue today our retail market, hotel market, land market, industrial market are doing well and are on the upswing. Multifamily and office, particularly B and C office, still facing challenges. So for the first time ever, we're going to have a very robust collection of discretionary sellers that there's a lot of pent-up demand to sell because we've had below-trend turnover for 7 years in a row Even during the S&L crisis in the early 90s, we only had 4 years in a row of below trend turnover. So there's pent-up demand in the system. As those sectors do better, people are going to jump in and sell to take advantage of those better conditions. And then we're also going to have a very robust collection of non-discretionary sellers in the multifamily and B and C office sectors that are not going to be able to refinance. And they're not going to be able to refinance because most refinancings today are requiring 25 to 35% cash in. And the rates are about double where they were for these maturing loans, and people are going to have to sell. So we have a bunch of people that want to sell and will be able to sell at a decent price, a bunch of people that will have to sell, and with those two groups being so active, I think we're going to have record turnover next year. So that's my prediction.
Francis, I feel from the energy, your engine revving. I'd like to hear your thoughts.
So Bob has convinced me. I am going to go get a broker's license and become a broker. But the dilemma of owners is different. And I have no doubt that what Bob said right now is correct. And I have no doubt that office buildings 5 years from now might sell for double what they're selling for today. However, if you are an owner, you have to look at your costs, and not only your cost in buying the property, you have to look at your costs for getting the property from here to there, i.e., in this example, 5 years from now. And that's where the glasses fog over a little bit. So, not to get mired in the detail, but if we look at an office building transaction, and the market in New York is more bifurcated than it's ever been between what we call the A-plus class, which are basically new buildings 5 or 10 years ago, where there used to be, you could say, a 30 or 40% premium on that class of office space. And today it's probably 2 to 3x, 2 to 300%. So a huge delta. If you want office space in a brand new building in Manhattan, you will pay between $150 and $225 per foot per year. But if you want office space in a B office building, you will pay between $60 and $75 a foot, and that's where the trouble begins. So, although I agree that public policy affects multifamily a lot, it also affects office a lot in the form of real estate taxes. So between real estate taxes and operating costs and some particular tenant services, cleaning, which is normally incorporated in New York gross rents, you can be looking at $40 plus taxes, operating, cleaning, all the way up to $45 as a base cost before you get to any return on investment, before anything else.
And before Local Law 97.
And before Local Law 97. Then, let's assume it's somewhere in the middle, you rent that space for $70. That means you have a delta on cost. Your profit margin, your gross profit margin, is $25 to $30 a foot. But let's take a look at what it costs to enter into that lease for $70. The tenant's broker, depending on how bold they are, will ask for anywhere from $100 to $150 in TIs. Oh, they'll probably ask for a year's free rent. That's another $70. So now we're up to $200. And then there's a commission, which typically will be another $25 or $30.
Can't forget the commission.
So to sign this lease costs you $225 a foot. So let's assume that it's a 10-year lease. Amortizing the $225 that you have to lay out in the first year is $22.50. You only had a delta to start with of, and rents, some rents are mid-60s, I'm using 70, of $30. But, excuse me, you're laying out $225 on day one. And so in addition to amortizing the $225, either you're going to pay the bank or you want to get a little return on your $225 investment. Point is, net effective rent in that metrics is zero. So whether you paid $300 for the building or $500 or whatever you paid, if you rented it up in today's market, your return is still zero. So that's a hard metric to look at. And for a long time, office building owners and banks had amnesia about, or, you know, the view, they forgot that leases come up, and when leases come up, tenants want new deals and new costs. And whatever they were doing, they were pretending that this was a permanent cash flow stream that wouldn't be interrupted. Well, it is. And that's the reality that the market is dealing with today, and why prices have fallen in half. And so that's a tough reality to deal with. That's office. Next, let's talk about multifamily. Well, we have rent laws in New York that were expanded and expanded and expanded. Right now, I don't know what the percentage of total housing in New York that's covered by stabilization, but it's probably
About 1 million apartments
out of
out of 3.3 million
So-
housing dwelling units.
35 or 40, are you sure, including tax abatement stabilized buildings?
No, that's just rent stabilized. It's not the new 421.
Yeah, so probably higher. Anyway, rent stabilization, if you look at the last 10 years or whatever, will allow you some very low single-digit increase, 1 or 2%, while your costs, including the city taxes, are escalating at multiples of that. So your rents are going up like this, and your costs are going up like this. So you're losing ground every year. So that's the complex reality of residential housing in New York, if it's in that stabilized or now fair eviction and all the other stuff that they invent. Because they all go to sleep thinking about, how can we pass tougher laws? And they're still thinking that way. So, you know, Bob's thinking about some
I'm thinking Bob's thinking he's not going to bring us his next hottest deal.
Herculean. I am buying a building in Brooklyn right now. First one I bought in probably a decade in New York.
What kind of building?
It's a tax abated, stabilized building. I'm not sure why I'm doing it, but some guys.
We're going to run this back for you.
Some guys in my office talked me into it. Nice building. Anyway, it's tough, and upside margin, political pressure, continuing. I mean, I hope Hercules comes along that Bob's thinking about and lifts things up. New York's sustained being, you know, it's interesting. We have a number of cities in the U.S., a lot of them you can talk about: Miami, Dallas, Houston, Austin, Nashville, whatever city you want. Tremendous growth rates, no housing crisis. New York, little or no growth rate in population. We have the #1 housing crisis in America.
And Bob, let's drill, like, you know, obviously we want to get into that. Why is that? Why do you think these politicians can't figure this out?
It's very simple. It's very simple. And whenever I talk to a politician, I always try to educate them. And the solution to all of our housing problems is completely on the supply side. And we do have elected officials that don't believe economics works. And even for those that believe that an Econ 101 textbook is capitalist propaganda, just look no further than the pandemic, right? People had leases expiring in Manhattan, moved out of Manhattan, vacancy rose significantly. Vacancy rising significantly is like adding to supply. Rents dropped 30%. 30%. There's not a housing policy that's been implemented anywhere in the United States that's made rents go down 10%. And we had rents go down 30%. So we need new supply. So why are the politicians not not in favor of more supply. And the hypocrisy knows no limit, because every one of them will say, we want New York to be more affordable for everybody. We want rents to be lower. We want everybody to be able to afford New York. Well, oh yeah, how come every single policy that's been implemented or ignored since 2018 has done nothing but the reverse? It's constricted supply and exerted upward pressure on rents, making the city less affordable for everybody. And why is this? Very simply, I will tell you, our ex-governor, Elliot Spitzer, is a friend of mine. He shares a story very openly about when Atlantic Yards was being rezoned. And when Atlantic Yards was being rezoned, they were going to build Barclays Center, and that rezoning was including 9,000 apartments, 25% of which were going to be affordable. And the local city council person, who will remain nameless, voted against the project. Elliot calls her up, says, hey, you got to come to my office. She comes to his office, says, how could you possibly have voted against this? There's going to be 2,400 affordable units in your district. Why wouldn't you want that? She said, Governor, in the last election for city council, only 7,400 people voted. You're going to bring 25,000 new people into my district that don't know me and might not vote for me.
You can't make it up.
That's the reality. That is the reality. And so why we don't have new supply? Think about just one issue, right? And there's tons of them, and I could talk about this for hours, so hopefully I'm not getting on my soapbox too much. But take it back to 1978, Yankees, Dodgers in the World Series. And for those Yankee fans out there, sorry to bring up Yankees, Dodgers again so quickly after the series. But 1978, Reggie's hitting all the home runs. Goodyear blimp is above the stadium, pans out. 6 fires going on within 3 blocks of Yankee Stadium. And Howard Cosell, the announcer, famously says, the Bronx is burning. Well, why was the Bronx burning? Because it made more sense for people to burn their building down than to invest in it back in those days. So the city smartly came up with 2 programs to incentivize the private sector to invest in the housing stock: the Major Capital Improvement Program, MCI, and the Individual Apartment Improvement Program, the IAI. These programs basically gave investors a 30% return on invested capital. So in 1978, the dilapidation rate in New York City was 14%, meaning 14% of the housing units were in such bad shape they were deemed uninhabitable. So these 2 programs went into effect. What happened? The private sector dumped tens of billions of dollars into the housing stock, so that in 2019, the dilapidation rate fell to 0.04%. And in the rent law changes, the HSTPA that was implemented in June of 2019 marginalized both of those programs. So what's happened now is the rent-stabilized unit that becomes vacant that used to be renovated for $150,000 and then the owner got an increase in rent are just simply being nailed shut. And estimates are that there are 70 to 80,000 of these apartments that are just sitting empty because there's no incentive to invest in them. So that further constricts supply, exerts upward pressure on rent, creates a housing problem. But think about it. I had lunch with the governor and I said, all you have to do, reconstitute both of these programs, you'd have 70 or 80,000 apartments in New York under gut renovation within 2 weeks. How much sheetrock are you going to sell? How much flooring? How many sinks, refrigerators, bathtubs, toilets? What an economically stimulative thing this would do, and it would lower the upward pressure on rents. It's too commonsensical. It's amazing what is happening. And that's one example of several examples that just don't make sense. And that's why we have a housing problem, is because of policies like that.
That was very well said, Bob. Seriously, that encompassed that perfectly. Francis, you want to add anything
Yeah,
to
I'll
that?
add a little color. So in the 2019 Act, notwithstanding that it costs $150,000, might be lucky, $120,000 to gut renovate average apartment. NYCPA spends $225,000 or whatever when they do it. When they passed the law in 2019, they said you couldn't spend more than $15,000. I mean, you can't buy a can opener for $15,000. And the return that you were then allowed when you did that was about 5%, of which the city taxes all residential income at a rate of about 30% or 40%. So that little 5% return that you got, they're going to take back 40% of it through taxes, or 35% or something like that. So it was absurd. And now there was a reform that was recently passed. It went up to $30,000. Still 1/4, 1/5 of what the real cost is. And just like you, I'm friendly with the governor, I know Elliott too, but with current governor, and of course discussed this very same thing that you did. And she's a very smart woman, and I like her. But she, and when we went all through the numbers, and you know, she got as close to a compromise as she could get. She knew it was an absurd compromise and it would never work. And they did the same thing in the revisions in the tax abatement program. The numbers don't add up. She said to me, well, maybe interest rates will go down. She's hoping for 3% interest rates, in which case maybe the equation. But she did the best she could, but the political forces were too strong. And anyway, a lot about why we have a housing shortage in New York, but that's why.
So we touched on it briefly, but maybe we'll just touch on it very briefly again. If you have any further comments on it, New York City retail, because that seems to be, I think, holding up fairly well, and just some, I guess, depending on who the tenant is, but certainly costs a lot to go to dinner. But any thoughts on retail?
Oh, I'll start. So retail, which in 22, post-COVID, during COVID was decimated because restaurants couldn't open, many businesses closed, nobody was shopping. So, you know, it was a massive disruption. And as the recovery began, whether that's 21 or 22, whatever you want to say, tenants had enormous negotiating power. If you could find them, you were grateful for it, and you cut whatever deal you could, probably at a rent that was close to, depending on what, where, somewhere between a half all the way down to a third, if you were in a very high rent district, to what you might have previously gotten. And we were still running massive vacancies. 30% wouldn't have been uncommon, probably. I don't know exactly what the number was, but you saw all those empty storefronts around the city. It was endless. We've now come back. Occupancy rates are better. They're not super strong, but they're better depending on the location. Certain locations are very strong. Rents, depending on the location, again, some have recovered a little bit, some have recovered a lot. So if you take a very premium location like Soho, Soho pre-COVID was maybe renting for $400 a foot, depending on the size and where. Post-COVID, probably $200, $250. Now it's $500 to $600 in some prime Soho locations. But that's not, that metric doesn't hold true in some of the more sort of neighborhood locations and less prime. So stronger, hasn't come all the way back, it's come a little bit.
And Bob, you know, from a demand to sales demand standpoint, I know you've covered and sold countless retail condos and apartment houses. Is there more demand for apartment houses right now or retail? Or I know sometimes obviously it's a collective.
Yeah, well, I'd like to talk about retail actually, because I think it is one of the most fascinating sectors in the market today. And even before the pandemic, everybody was talking about how, online shopping is going to kill retail. And retail definitely was hurting. Years before anything else, the retail sector was being impacted. And the general consensus about it was that online shopping was the thing that was really hurting retail. I'll throw out a different perspective on that, because at the same time retail started to get negatively impacted, a sector that had always been kind of the stepchild of real estate, industrial real estate, started to actually begin its ascension. And even when retail and office and apartment buildings were seeing cap rates at 5% or 6%, industrial real estate was trading at a 7% return, 8% return. The cap rates were always higher. It was always thought of as kind of the grimy part of commercial real estate. And I think what happened is that retail and industrial became very, very linked. And I think what happened was a realization of retailers that, hey, I don't have to have a 20,000-foot store and have 75 pairs of the same size and style jean in my store, which is the most expensive space I could possibly rent. Maybe I only have a few pairs here, and I store it off-site in some place that's close. And so I think what happened was this realization that I don't have to sell and store goods in the same very, very expensive space, led to the ascension of the industrial sector and a simultaneous drop in retail. So I think if you link those two asset classes together, the diminution in the value of retail was not as much as it was, and the increase in the value of industrial wasn't as much as it was, because they kind of were playing off each other. And so I think today what we have in the retail sector, because retail was negatively impacted so many years before everything else was, I think the perception of the retail market is that rents have stopped going down, and they are lower than they were at their peak, but they've stopped going down. If anything, there's upward pressure on them. Leasing volume is picking up, and the perception is that there is very little downside risk in retail. So unless you have a legacy lease that's still way over the current market, there's no downside in retail today. If you have fresh leases in retail, I don't think anybody thinks those rents are going to go down. So I think it's actually a very safe asset class to be investing in today. And I think I'm very, very bullish on that sector.
Good, that's insightful. Two more topics. We can keep them brief because I want to leave a little bit of time for a few questions if we have any. Where's the opportunity today?
Well, we're as you know, national and international buyers, and even though I'm buying a building in the Bronx, first one in probably 10 years, we do buy a lot of properties around the country and around the world, and we're always studying different markets. And clearly, I would say, in our own buying patterns, warehouse nationally has clearly been the big story of the last 5 or 10 years. I mean, I'm just selling a warehouse, a crappy warehouse that I bought in Charlotte, North Carolina, in maybe 15 years ago for, I guess, $12 a foot or something, or $10 a foot. I'm just selling it for $60 a foot. So 6 times my purchase price. That's pretty good. That's like New York used to be. And I could tell you that story nationally from our portfolio many times over. So.
And an older building,
Yeah,
old vintage.
But I can tell you about, we have a large industrial complex next to Miami Airport. I bought it, rents were $550. We hoped they'd go to $750. They went to $9, but then 2008 they went back to $550. They're now $21.50. Good story. So national industrial is a really great story, and we continue to buy it all the time. Probably buying a million feet or so as we speak today, in a variety of deals. National retail. We always had we're value buyers, we're contrarian buyers, we try to outthink the market, get a better deal than normal. So over the last 10 years, as Bob said, everybody thought bricks and mortar retail was over. We didn't. And I could go into a variety of reasons. But we probably bought, in the last 10 years, 100 shopping centers nationally. So we have a very big footprint. And we are continuing to buy national retail, which is now, surprise, surprise, no, all retail didn't end up in as non-bricks and mortar sales. And retail is actually nationally having its strongest period ever. And occupancies are great, rental rates are great, rents are going up every day. So that's an area nationally of opportunity. And we haven't talked about the big O from a national point of view, which is office. And even there, we're seeing an opportunity, and we're buying our first office building probably in three years or so, or 4 years. It's a Class A market. It's outside of Philadelphia.
King of Prussia.
Well, it's Malvern, which is
Malvern,
next to
yeah.
King of Prussia. But deeply discounted with very good in-place cash flow, 7 years WALT, very strong profile, under-occupied, but making a lot of money as it sits there, buying it at a double-digit cap rate. I can live with that.
Capital and courage.
So, and you know, internationally, as you know, I mean, we came close, but then had a little bit of a problem. We're buying a major asset in Scotland, which had traded down from probably 300 million pounds to 65 million pounds.
And that was a bummer. I was excited
That
about
was
that
a bummer. Found out that this is a very large mall, and 3 or 4 blocks on the best retail in an important Scottish city. It had the largest glass ceiling in Europe over the mall. Needed a little bit of repair, 38 million pounds. That put a damper in the deal.
Bob, and I'll combine this too for you. And you know where the opportunity for you could be geographically inside the city. I know you've always historically been great about finding areas. Where do you see the opportunity?
Yeah, well, I think nationally, and I don't do anything outside, so this is just looking at the world from 40,000 feet. I think technology has changed the world so much and will continue to change it. I mean, I think back to 1984 when I started in this business. I had no computer on my desk, no fax machine, no cell phone. We carried rolls of quarters around. So we were out in the field. We could go to the corner of the phone booth and make a phone call. And you think about how much the world has changed over the past 40 years. I think the extent to which the world is going to change over the next 5 years is going to blow the past 40 away. We are, and not me, I'm happy my cell phone goes on in the morning, but my firm is using AI in a big way. The first person I hired for the new firm 8 months ago was my COO, who's an AI guru. He started AI companies. He worked in driverless cars for 6 years. We're using AI in all kinds of cool ways, and we're using a piece of software that just came on the market 2 months ago. And we think it's the coolest thing in the world. And now a new thing comes out today that makes the old thing from 2 months ago look like a dinosaur. The new thing is bigger, faster, broader, more powerful. Amazing the rate of change. And I think because of that and how AI is going to be incorporated into so many things that we do, I think AI, there's a downside to AI too from a societal perspective, but that's another story for another day. But I think because of that, data centers are going to be huge. I think the data center world nationally is going to be wild. Look for unbelievable things in that world. In terms of opportunity in New York, this is probably going to shock a lot of you, but I think that 10 years from now, the coolest place to live in New York City is going to be in the Garment Center. Probably saying, what the heck? You know, Midtown South rezoning is likely to pass in the beginning of next year. And what's going to happen, what happened was our policymakers brought a new residential tax abatement into effect called 485X, which is the predecessor to Affordable New York, which is the new iteration of Affordable New York, which was a new iteration of old 421A tax abatement. The new 485X is a totally worthless piece of garbage. Nobody is building under 485X. It makes no sense at all. I think
Unless interest rates go to 3%, which is the governor's point of view.
the policymakers understand that they totally screwed it up, and they have egg all over their face. And so what they did is they said, hey, our next big initiative, this Midtown South rezoning, we can't let this thing be a big failure too. So they went overboard, and they proposed these densities that basically, if approved, I think half the buildings in the Garment Center are going to be demolished within the next 10 years. And it's going to be a completely new city. It's going to be a link between the Penn Station, Hudson Yards, and Midtown. I think it could be the coolest place ever. I'm so excited. I moved my office right into the middle of the Garment Center on 36 between 6th and 7th because I think all the action is going to go on there. Property values are going to go skyrocket. Buildings are going to be demolished left and right. It'll be great for housing. It'll be great for the office sector because we'll probably have 30, 40 million feet of office buildings demolished. Which we need because we have about 90 million feet of empty office space. So I think the Garment Center, believe it or not, I didn't even want to walk through the Garment Center years ago. I think it's going to be the coolest place in the city.
You know, you got the Knicks and the Rangers. You got Penn Station, which could use some help. So I hear where you're going with that. All right, last question for each of you, and then we'll wrap up, see if anyone has any questions. I started with what keeps you up at night. So I'm going back to you, Bob. What gets you up in the morning? What excites you?
Oh, the love of the business. This is great business. Come on, I get to talk to cool, interesting people like Francis and you all day. I think the real estate business is the greatest business in the world. I really do. It's something different every day, a very eclectic mix of folks from folks like Francis and Steve Roth to the proverbial little old lady who's owned the building for 100 years. And it's one thing I always say that the three characteristics I see in the brokers who do the best in the business are, number one, they're an expert at something. Number two, they have passion. They love the business. Number three, they use discipline well. But that passion for the business is something that I think if you have it in you, it never goes away. And so that's what gets me up every morning is just the love of doing what I do.
Great. And, both of you obviously fabulously successful. Why do you keep doing it, Francis? What gets you up?
Well, combination of things. One, I would echo what Bob says in a slightly different way. It's you, my colleagues, that people I work with. They're all, not all, but many of them are young like David, but they've worked with me for 20 years. A building by itself is a white elephant. It needs people to make it an environment that's attractive to other people. So that energy is something, different version of what you said, but the same thing, is one of the things that keeps me going. And of course, in my old age, I've discovered that I like to build skyscrapers. We just built a 74-story building in Chicago, which is doing fabulously and is considered the best multifamily asset in the city. And Chicago is a city of architecture, so that's an accomplishment. So I love design, I love architecture, and whether I'm taking an old crappy office building and shining the apple and making it a better place to be, or building some high-rise, that gives me a thrill. Plus, I've spent getting on 6 decades doing this.
You started young, though.
Started young. Started when I was 15. So, few people like us, so we end up with having a lot of firepower. And I've been training for this for 50, 60 years, and now that we have the ability to realize projects, realize things, affect change, and do it with expertise and care, that gets me up.
Well said. Well, before we get to some questions, I just want to thank both of you. Obviously, I hold both of you in very high regard, and as always, you always say thoughtful things that I'm sure everyone appreciates. I'll open it up to a couple of questions. No pressure, but anyone have any questions they want to? Yeah.
So I actually agree with a lot of what you said. I'm particularly I know after the 2019 tax laws came out, we wrote a pretty scathing article of the city politicians. No one's really doing it. It was great. The one thing, I know that a lot of people want to see it turn around, and the one thing I didn't hear was like the city budget, right? 40 years ago, 10% of the city budget was based on real estate taxes. Now it's something like 40%. And do you think that they can turn that around? Because right now they're living on their real estate tax budget. If they can't turn that around, that's one of the biggest expenses. And I don't see how politicians can get away with fixing that.
Well, we're trying to get some clarity on that, actually, and that's an interesting point. So a couple of more statistics. You guys probably figured out by now I love statistics. The real estate industry contributes 54% to the city budget in the form of real estate taxes, mortgage recording taxes, transfer taxes, and other charges and fees. So the fact that real estate people are looked at as villains in this city, and a lot of politicians won't even take a campaign contribution from a real estate person, is beyond me. But one of the things that is concerning is that I know in 2019, 27% of our city income taxes were paid by 1,600 families. Those families all have multiple homes, so easy for them to change their domicile. I wonder how many of those folks still are paying taxes in New York. And I sit on the executive committee of the Real Estate Board of New York, and we had in the guy who runs the budget for New York, and I asked him how many of those 1,600 families are still paying taxes in New York, and he either didn't know or wouldn't answer. And so I said, if this guy, who's the number one person in all of New York out of 8.5 million people, this is the one guy who would know, he either didn't know or didn't want to answer. That's a big concern. So where the budget really stands is something that someone needs to do some investigative work on and shed some light on, because I can't imagine that it's in good shape.
Maybe faced with that reality, that's when they'll propel some change, some forced change in that way. Kim.
What is the media missing when portraying the office narrative? And is there a disconnect between the public's kind of perception of the office market versus what's actually going on?
Well, Ryan Simonetti, who's the head of a amenity firm in New York, who's a very smart guy, says, don't follow the headlines, follow the trend lines. Don't follow the headlines, follow the trend line. And as we look at the office world, I see many businesses realizing that work at home doesn't fulfill a number of things. It doesn't make people who work really accountable, because there's no way you can know what they're doing or what they're working on. One of the essential functions of all businesses is to train people. They do one job and they have some ability to move up, you got to train them. It's really hard to train people over Zoom. I mean, we know that online education is a failure. When we relied on it in New York post-COVID, results fell by a third. You can't really, it's hard to create a culture online. All the essential purposes of businesses don't get fulfilled online. And we're starting to see that occur in and recognition by businesses. Facebook, the last layoff, first people they laid off were the work-at-home people. Goodbye. Thanks very much. People who work in government who oversee banks and security companies say there's no accountability at home. People have to be in the office. So they're pushing regulation to require people to have an in-office, significant in-office presence. Look at all the tech companies. They're still building new office buildings in New York and around the country. So I think there's a change in attitude, or the experiment has occurred and it's not working very well. And that, I think, is going to, and businesses were confused at first. First, they didn't know whether everybody was going to stay home or they're going to come to the office. They're also confused about how much space they would need to accommodate people. Well, it turns out even if people are in the office 3 days, they still expect to have a chair to sit in when they are there, and a place to leave their crap when they're not there. And no, they don't want somebody else sitting in their office rifling their desk. So it turns out that even if people are there 4 days or 3 days, they still need the same amount of footprint that they otherwise do. I mean, I know about, hoteling desks. Really doesn't work. So I think the trends are going towards away from the vision of everybody's going to stay home and businesses will need less space, and they'll end up, and we see national office leasing not only ticking up, but there's a real heartbeat out there, and even in New York. I mean, Marianne Tide came out with an article yesterday. She sees an significant tightness occurring in New York office within 24 months.
You just have to go around the New York metro area to the train stations and see how many cars are parked, because it's doubled and tripled in the last 6 to 9 months, probably.
Yeah, I think the biggest misconception that the media is missing about the office sector is that you can't paint the whole office sector with a broad brush. Class A new construction is really doing well. Demand is there, and it seems like across every property type there is tremendous demand for new. Look at how the condo projects on the Upper East Side are doing west of 3rd Avenue. Every one of them is doing great. And it's not the foreign buyer that's coming in. It's actually the New Yorker that's tired of living in the co-op where they can do renovations for 2 months, 2 weeks in August, and there's no amenities to speak of. Mostly 75% of the buyers of Upper East Side condos are New Yorkers that are moving out of co-ops. So there's a big demand for new, and in the office sector, if you have been in any of the brand newly built office buildings versus being in an older office building, it's really like night and day. And so I think Class A is doing really well. That message isn't getting out there enough. And then I think we're going to have, over the next several years, a disaggregation of the B and C office into 3 buckets. The bucket that will be upgraded and stay office, because every tenant can't pay the triple-digit rents that Francis referred to in the new buildings. There's a section that's going to be converted to residential. We need residential desperately. There are programs to make it more economically feasible to do the conversions. And then we're going to have a lot of demolitions for 2 reasons. One, there are zoning changes that are going to precipitate that. And also the value of some of these buildings are getting to the point where even when you layer on demolition costs, you're below land value. So I think I'm a believer in the office sector moving forward. I also think for young people, not being in the office, kiss of death for them.
Yeah, it's a huge advantage.
And the ability to create a corporate culture is nearly impossible on Zoom.
Huge advantage for the young people coming up in the business to be in the office. Last question, because I know we're running tight on time, and we'll keep it brief. Michael.
Well, thank you guys for presenting today. It's great stuff. I can listen to you guys like my daughters listen to Taylor Swift. It's so good. Just to hop onto that conversation. Sorry to harp
What's
on
wrong with you,
office
Mike?
here. But Francis, you painted a pretty bleak picture about the desire to invest in office. But then on the flip side, you talk about the trend lines being positive. Bob, you talk about the prices coming down so cheap that this is a generational opportunity. When do you see it, or do you ever see this as a time to hop into investing in the office market in New York again?
Michael, I think the time is now. I mean, I don't invest in property. I've always tried to not have any conflicts of interest in my life, so I actually sold a lot of buildings but never bought one. But I think that, you know, if you know what you're looking for and you buy in the right spot, I think today's a great time to be buying office. And I think it may even get a little better. It depends what's going to happen. I mentioned briefly Local Law 97. For those of you who aren't aware, Local Law 97 is the law that it's not a law, it's a tax on older buildings to reduce their carbon footprint. And very, very few owners are even thinking about it today, even though a clock is ticking by which you have to meet these requirements or pay very, very stiff penalties. But owners don't even know if they're going to own their building next year. Forget about deciding to invest millions and millions of dollars in to comply with this new law. And that probably is going to drive a little further, exert a little downward pressure further on office. But I think, to buy an office building for $200 or $300 a foot when the land is worth $400 a foot, how could you not do that? But you have to have the staying power to last.
That's why Bob's the best.
Until you get to that better time, you have to figure out how you can hold on by not over levering it or buying it for all equity or something like that.
We're trying to end on a positive note, so keep that in mind.
Look, if people know what they're doing, if they have the deep pocket to get from here to there, it's okay. Then, I would agree. $300 a foot is a good entry point. But amateurs shouldn't apply.
Okay, I think that's a good way to end it. Thank you, guys. Thank you both. Great job.
That was awesome.